Your lease renewal lands in your inbox, and the same day the news says mortgage rates are lower. So you check a few listings, maybe buying can finally beat another year of rent. You open the same starter home you saved last month. You type it into the calculator, and then the number shows up. Still too high.
This video is not about whether you should buy a house or keep renting. It is not a buy now or wait for later video. It is about why a lower mortgage rate can help, but still may not save the full payment. Because the headline can be right, and your calculator can still say no.
Start on a Tuesday night. Rent has cleared from the checking account. Groceries were more than you expected. The car payment already posted. Car insurance is due soon. Maybe there's a student loan minimum sitting there. Maybe daycare took a bigger bite than usual. Then, in the middle of that week, you see the headline, mortgage rates moved lower. For a second, it feels like the door might finally open.
So you check the listing app again. Not for a mansion, not for a dream kitchen, just a normal starter home. A place with enough space, a commute that does not add 40 minutes each way, maybe a second bedroom, maybe a small yard, something that feels like a reasonable adult goal. Then you run the payment, and the disappointment is quiet. The rate got better, but the payment still does not fit inside the month you actually live in. Here's the part that gets hidden behind the rate. The rate gets the headline because it is easy to print. The payment gets ignored because it has too many moving parts. And the headline is not what leads your checking account every month. The payment does. A mortgage payment is not one bill, it is a stack of smaller bills wearing one name tag. First, there is the home price, then the loan amount, then the interest rate, then property taxes, then homeowners insurance, then maybe PMI if the down payment is under 20%, then closing costs, then cash to close. So when the rate falls, one piece of the stack improves, but the rest of the stack is still standing there. Freddie Mac reported that the average 30-year fixed mortgage rate was 6.43% on July 2, 2026. That was down from 6.49% the week before and down from 6.67% 1 year earlier. That is real movement, but real movement is not the same as real breathing room. NAR reported that the median existing home sales price was $429,300 in May 2026. That was up 1.3% from a year earlier. So make it concrete. Imagine a $429,300 home, 20% down, 30-year fixed mortgage, principal and interest only. At 6.49%, the payment is about $2,169 a month. At 6.43%, it is about $2,155 a month. That is about $14 less per month. $14 helps, but for a household already looking at rent, groceries, a car payment, insurance, and childcare, $14 is probably not the difference between locked out and comfortable. Even compared with a year earlier, the difference is limited. At 6.67%, the principal and interest payment would be about $2,209. At 6.43%, it is about $2,155. That is about $54 less per month. Again, that matters, but it still may not change the decision because principal and interest are not the whole housing cost. The CFPB's loan estimate explains that the total monthly payment can include principal, interest, mortgage insurance, escrow, property taxes, and homeowners insurance. It also points buyers to closing costs and cash to close. That is where the calculator starts to feel different from the headline. The rate falls, but the property tax estimate is still there, the insurance quote is still there, the PMI line may still be there, the cash needed at closing may still be there, and the checking account still has to survive the rest of the month.
And there is another twist. A lower rate does not only help one buyer, it can bring other buyers back too. The renter who paused their search may open the app again. The couple that gave up last month may call a lender again. The family waiting for a better rate may start touring homes again. So the small opening may not stay quiet for long. That does not mean prices always rise. It does not mean every city reacts the same way.
Housing is local.
A buyer in Ohio is not facing the exact same market as a buyer in Florida, Texas, California, or New Jersey. But a lower rate is not something only you get to use. Other buyers see the same headline, other buyers run the same calculator, other buyers are looking at the same starter homes. This is why the better question is not just, did mortgage rates fall? The better question is, did the full payment fall enough to fit real life? Because approved is not the same as comfortable. A lender may look at income, credit score, debt, and the loan file. But the household has to look at Friday, the electric bill, the grocery run, the car insurance renewal, the daycare payment, the emergency that shows up without asking whether rates improved.
That is where buyers feel the gap. They are not confused because they fail to understand the headline. They are confused because the headline is talking about one number. Their life is dealing with the whole stack. And this can still apply if someone has a good credit score. A strong credit score may help with loan terms, but it does not make the listing price disappear. It does not remove property taxes. It does not cancel homeowners insurance. It does not turn closing costs into pocket change.
That is not blaming buyers. A person can be responsible and still run into a payment that does not work. A person can save carefully and still feel behind if prices move faster than savings. A person can earn decent money and still feel locked out if the starter home now comes with a payment that feels like a second rent. The mortgage rate is the loudest number, but the full payment is the number that enters your life.
So when you see a headline saying mortgage rates are lower, do not stop at the rate. Read the line that says estimated total monthly payment. Not as personal financial advice, not as a buy or wait rule, just as a clear way to understand the headline. One educational way to read it is to ask, are taxes included? Is insurance included? Is PMI included? How much cash is needed to close? And after all of that, does the number still leave breathing room after the normal bills?
Because a lower rate can open the door a little. But if the price, taxes, insurance, and upfront cash still block the doorway, the buyer may still not be able to walk through. That is why lower mortgage rates can still leave buyers stuck. Not because lower rates are meaningless, they are not, but because buying a home is not one number. It is the number that has to survive the rest of the month.
So if that lease renewal is still sitting in your inbox and the mortgage calculator still feels discouraging, you are not wrong for feeling confused. The news may be talking about relief, but your household is dealing with the full payment, and those are not always the same thing. If this helped you understand the payment behind the headline, subscribe for more calm money explanations for real life.